All right. Hello again, adventurers, and welcome to another exciting daily vlog. This is Daily Vlog 2025, number 28. And today, we are going to be going back into the business world to answer some questions about how can I turn my hobby into my living. So today, last time we talked about can you turn your hobby into a living, and I showed you really kind of simple ways to understand budgeting and figure out how much money you actually need to make before you can consider quitting your job and doing your hobby, whether it's YouTube or dungeon mastering, whatever it is, full to the time. Today, we're going to talk about probably one of the most important first steps that you can take when changing your hobby into your living, and that is deciding on what business structure you're going to use. If you are new to the channel, I am doing this entire series about, the business aspects of turning your business into or your hobby into a business. So if you're interested in more stuff like that, feel free to subscribe to the channel. If you like stuff like this, hit the like button, hit the bell icon to turn notifications on. All those things are super, super important. So let's talk about business structure. And why does it matter? Well, in the U.S., and don't worry for those of you that are not located in the U.S., I will be dedicating a portion of this video to talking about the differences between U.S. business law and some of the non-U.S. business law that I'm familiar with, which is mostly going to be European in general. So why, let's try this one more time. Why does your business structure matter, or anything like that? Well, a lot of it is going to come down to taxes. Like that's the big thing that a lot of new business owners, it's one of the biggest things that trips up new business owners or people that are new to being self-employed or being an independent contractor. Taxes are the thing that trip up so many people because the U.S. tax code is monumentally complicated. And there is a very, very large difference between just being a regular human being in the U.S. and having your own tax liability and running a company and having that company's tax liabilities and liabilities in general. Like, as soon as you start operating a business, everything changes. And things that didn't used to matter very much anymore start becoming extremely important. Things like if you lie to someone as just a regular, normal human being, they can get mad at you. If you lie to someone as a corporation, they can sue you. They can have criminal charges filed against you, depending on the type of lie that you did, and you can lose everything. And the thing about a business structure is some businesses are, according to the government, which is what really matters in this point, some businesses are inseparable or indistinguishable. There's the word I was looking for. Indistinguishable from the person that owns the company, meaning anything that you do as a personal, just regular person also counts as you doing it as a company. And the same thing is true. Anything your company does also counts as you personally doing it. And so if something happens, your company does something wrong, you are personally liable for that. And that includes any damages you have to pay, any attorney's fees that you have to pay, and that means anything you own can be taken in order to offset the damages that you have to pay. So you've got a car, they can take it. You've got a house, they can take it. Anything with sufficient value. You've got a really expensive computer, they can take it. So Figuring out what kind of business structure that you want to utilize is really, really important because it helps you to understand where the business stops and you start. And it also declares to the government, hey, this is business, this is me. Anything over here, you're not allowed to touch. So, what are the different business structures? I'm going to go over a lot of different ones. However, for the vast majority of hobbyists that are turning into business owners, you really only need to understand 3: sole proprietorship, partnership, and a corporation. Now, there's subsets underneath those, but we'll get into them. However, the whole list of businesses, you have sole proprietorships, you have partnerships, you have limited liability companies, which technically don't exist on a federal level. We'll talk about that in a little bit. You have C corporations, you have S corporations, you have benefit corporations, you have nonprofit corporations, and you also have, what are they called? A cooperative. All of these exist separately. Some of these you can actually technically be 2 different things in there. And most of them have very stringent requirements for what can be done when you are operating as that type of business structure. If this sounds complicated, it is. There are lawyers that the only thing that they do, the entirety of their job for the entirety of their career, is just dealing with different types of business structures. So how does that affect you as a small independent creator that wants to start, making money and making a living off of their hobby? Well, as much as everything I just talked about is very complicated, when we start talking about very specific things, it becomes relatively simple. The first thing that you need to understand is the second that you start accepting payment for something that you are doing, congratulations, you are now a business owner. The second money changes hands, the IRS and the government, your state government, everybody now considers you what's called a sole proprietor. And you are now the loving owner of a sole proprietorship. Basically, what that means is you and your business are the exact same thing. And that means any time that your business makes money, you make money, and vice versa. You're exactly the same. There's nothing that separates you and your business. That's what a sole proprietorship is. It's one of the most common businesses in the country, in the world, because again, the only thing required to create a sole proprietorship is to accept money for something that you're doing. It's very, very simple. There's no paperwork that you really need to file in general. When you're dealing with taxes for a sole proprietorship, you actually pay regular personal income tax on your sole proprietorship earnings. The big difference is anything that you make from your sole proprietorship has a few extra taxes that you have to deal with called self-employment tax. Self-employment tax is basically paying all the taxes that if you were an employee, your boss would be paying for you. I think the current self-employment tax right now is about 15.3%. So in addition to having to pay income tax and all the other things, you also have to set aside an additional 15% of your income, roughly, for self-employment tax. And self-employment tax basically pays all of the taxes that would normally be covered under payroll taxes, things like Social Security, Medicare, unemployment insurance, things like that. Those are all kind of covered under this lump self-employment tax. If you are running a sole proprietorship, it means filing your taxes becomes slightly more complicated. It's not massively complicated, but it is a little bit more complicated. Again, because of how common sole proprietorships are, there are so many different tools out there that you can use to make running a sole proprietorship as simple as possible. There's a lot of business software out there that helps you to try and to track different things. Something that a lot of people aren't 100% comfortable understanding is the difference between revenue and profits. Revenue is the total amount of money that your business brings in. Profit is the money that you make after you pay all of the expenses required for the business. And if you're not tracking everything that you're spending for the business, figuring out your profit versus your revenue can become very, very difficult. And if you declare your profit incorrectly, that can get you in trouble with the IRS. And you don't screw around with the IRS. Al Capone didn't get thrown in jail for any of the myriad of crimes that he committed. He got thrown in jail for tax evasion. IRS is nasty when they want their money. So understanding how to figure out what is profit, what is revenue, can be one of the more difficult things to do in a business in general, but especially for a sole proprietorship. Now, the downside of a sole proprietorship is you and the business are exactly the same thing. And that means if something goes wrong with the business, let's say, I've used this example before, let's say you've decided that you like making coffee mugs with your own artwork on it. You've decided that you are going to turn this hobby into a business, but you don't want to, go through all the process of LLCs or figuring out if you're an S Corp or a C Corp or anything. So you're just, going to be a sole proprietorship. There's not that big a deal. I ship them out to people using UPS. It's super easy, super fine. I don't have to worry about it. Well, let's say one of your coffee cups, for whatever reason, has a defect in it. One of your mugs has a defect, and somebody fills it up with super hot coffee. They lift it up, it falls, shatters, and they get second or third degree burns. It wasn't their fault. Because you were the person that sold it to them, you are going to have some amount of liability. And figuring out how much that liability is going to fall to courts, and effectively who has the better lawyer, which is expensive. At the end of it, you could be found liable for not only medical bills or whatever they did, if they decide that there was neglect involved, as in their lawyer is able to prove that you should have known that there was a problem there, and because you just chose not to take the steps necessary to prevent that problem, you are now guilty of neglect or criminal neglect. You could be facing even more fines if they find out it was intentional, where it wasn't just, oops, I didn't realize it, but you actually knew that there were some problems, but you went, you know what, it's not that big a deal. People aren't going to be putting hot liquids in my mugs. So I don't need to worry about it. That creates even more liability. And when the bill comes, a lot of this stuff just doesn't go away because, I'm going to declare bankruptcy, which is a really, really bad thing to do. It ruins your credit. It ruins a lot of different things for you. You don't want to do that. But even bankruptcy can't get you out of certain types of debt. And once the business is worthless, like they sue you and you have all of these mugs that you haven't sold that you're planning on selling to keep the business running, they take all of your inventory and they sell it themselves for whatever is easiest for them to do. Okay, well, I have this cool printer that I use. That's gone now, too. They're going to take that to sell it. Well, what about all my arts? All those are gone, too. However, once they're done liquidating the business assets, they start looking at your personal stuff. Do you have a house? That's gone. They get to keep it. Do you have a car? They're going to take that. Anything of sufficient value, they're going to take and sell to offset the cost of the damages that have been awarded against you. And then if they take everything that you own and you still don't have enough to cover the damages, then they start having to deal with criminal law. You are now in contempt of court because you're not doing what the court has told you to do, which is pay them money. And it can turn into wage garnishment, meaning if you do get another job, before you get your money, they take some of it away. It can lead to prison time, depending on how you were convicted and things like that, whether it was civil or criminal or anything like that. Like, it can be a really, really big deal. So that's one of the big problems with a sole proprietorship is it has what's called unlimited personal liability. You and the business are the exact same thing, and something bad happens, you didn't anticipate it, you're kind of screwed. If, however, you realize that working alone is not something that you want to do, maybe you have a D&D show or a live play show, and you want, you've been doing well enough with this live play show that you want to turn it into your full-time job for everyone involved. Well, you can actually form what's called a partnership. A partnership is effectively the same as a sole proprietorship, except there's multiple people that are involved. And part of the process of creating a partnership, because it is more complicated, is you actually do have to define how much of the business each person owns. So let's say you have 4 players and 1 GM. You all decide to form a partnership to be able to make money all together. And you decide that, well, we're all equal parts of this, so we're just going to split it 5 ways. That means each one of you has a 20% stake in the partnership, or it's 20% ownership of the partnership. And that means when profits are concerned, every person is entitled to 20% of the profits. It also means that every single person is entitled to pay 20% of the taxes that the partnership makes. We'll talk about how to pay yourself a little bit later after we get through all of the different business structures. But even if for whatever reason you don't take your money, you leave it in a joint bank account and go, you know what, I don't need that, I'm not going to use it. As a partnership, you are still liable to pay taxes on the money that you haven't personally taken. The other problem with partnerships is, as much as everybody is equally profits are they're equally entitled to a share of the profits. They're also equally entitled to paying a share of the taxes that the company has to make. They're also equally liable for anything that goes wrong. So if one of your partners does something wrong, because the partnership is technically an unlimited personal liability, the collective of you guys, there is no real separation between the partners and the business itself, aside from the fact that you only exist as 20% of the business. That means you're also on the hook for 20% of any damages that the business incurs. And that also means if you can't pay your 20%, because unlimited personal liability, they will take anything that you own to be able to do that. So partnerships create an even stronger amount of liability, because any one of the partners can do something wrong, get sued, or get criminally charged, and then everybody in the partnership is now liable for it. So again, sole proprietorships and partnerships are monumentally simple things to create. Sole proprietorship is literally, give me money. Hey, look, I have a sole proprietorship. Partnerships requires an agreement to somehow be decided upon, specifically how much of the company does each person own. But beyond that, it's the same basic thing. As soon as you start collecting money as an entity, congratulations, you now have a partnership. But that ease of creation also comes with some pretty big liabilities, especially when you're dealing with a partnership. In general, never, ever, ever, never, ever, 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 never, 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 ever, never, never, ever get into a business with someone that you cannot trust. Because once you are attached to a business, even if you're doing something with limited liability, having an untrustworthy person as a partner in your company, as a shareholder in your company, having the ability to make statements on behalf of the company can come back and bite you in the butt. So be very, very careful if you are considering starting a business with another person, and make sure that they understand as much as you understand about how the business should be run and the things that you should and shouldn't do. So we're going to skip over LLCs for a second here. We're going to go to corporations. Corporation, either a C or an S corp, we'll talk about the differences in a second, is the kind of final, really common thing for turning your hobby into a business. And the big difference between a corporation and a sole proprietorship or a partnership is the fact that in a corporation, you are not the owner of the company, you are a shareholder. And because of that, you have to be treated differently. If you're getting paid from the company, you are going to be an employee of the corporation, not an owner that just gets to take some of their profits. In corporations, if you are working for the corporation, meaning you are creating anything that makes the corporation money, you have to be an employee. They have to pay you an hourly wage, a salary, something like that. They have to follow all the labor laws involved in having an employee, things like that. The benefit of it is you get to get away from that corporate tax or that self-employment tax, because the company is going to be paying taxes on the salary that they pay you. Corporations are significantly more complicated. They require significantly more structure, especially if you're dealing with an S corporation. We'll talk about that in a second. And they fall victim to what's called being double taxed. What that means is when a corporation makes profit, they have to pay corporate income tax. Remember, I said profit, not revenue. That means money more than it costs for the corporation to work. They have to pay corporate income tax, which varies based on where the company is incorporated, exactly how you're making the money, blah, 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 blah. It's very, very complicated. However, that income, that profit is taxed. Then, when they pay you, you are also going to be paying personal taxes on your salary. And if there is money left over after they've paid you salary, that's that profit. Salary actually counts as operating costs. If there's money left over in that profit, you actually can get some of that money on top of your salary in the form of dividends. You're a shareholder, you get dividends, but then you're going to have to pay taxes on your dividends depending on the various tax laws. So that's what a double taxed corporation is you the company itself pays taxes on the profits, and then the members will pay taxes because they count those profits as income. So you pay both income tax and corporate tax. Like I said, it's very, very complicated. If you are considering forming a corporation, this is when you want to talk to a business law expert. Not me, someone that actually has a degree in business law, that is licensed by the bar in your state to actually practice business law. Yes, it does cost money to talk to a lawyer, and it can become very, very expensive. It's worth it. 100% it's worth it. They will help you to file all the necessary paperwork and stuff like that. And it makes it significantly easier to be able to do it legally and not have to worry about paying ungodly fines and things like that could end the business before it goes. So why would you ever want to be a corporation instead of a sole proprietorship, partnership, or limited liability company? Well, that being an employee thing is really, really nice. Corporations can also get can raise capital in ways that limited liability companies can't. You can do things like an initial public offering. You can sell your stock and make money off of that. You can privately give stock out to for investors and basically make them a stockholder to be able to get more capital for your business to be able to work. So if you're planning on having a large business, an LLC will only take you so far. Now, I've said this quite a few times. There are two different types of corporations that most hobbyists turned business owners would deal with. You have a C Corp and an S Corp. The big difference between an S Corp and a C Corp is an S Corp is a C Corp with more restrictions on it. So it's kind of like every square is a rectangle, but not every rectangle is a square, because a rectangle just requires 4 right angles. A square requires 4 right angles and 4 equal length sides. And that's kind of what an S Corp is. An S Corp limits you even more, where you can't have more than 100 people that are shareholders in it. So if you're planning on making a very large company, you can never have more than 100 shareholders ever. And you're also limited to who can actually be a part of your corporation. S Corps are a U.S. based entity. Every one of these shareholders or the owners, whatever you want to call them, has to be either a U.S. citizen or a legal resident. So if your particular live play show has people from other countries, like maybe you have a few people from England that play, or Australia or something like that, you cannot form an S corporation with them being a part of the business, because it's just not, or them being shareholders of the business, because that's not what S Corps are allowed to do. S Corps can still technically operate internationally, in the idea that you can do business in other countries, but it becomes significantly more complicated because you can't actually have anyone that is a shareholder that is not either a U.S. citizen or a legal resident. So all that said, if you are considering doing a C corporation or an S corporation, get a lawyer. There are a lot of benefits to it, but they're really only going to be benefits if your hobby that you're turning into a business is going to become a very large thing, and you're expecting to not be able to run it on your own. Something like Linus Tech Tips runs a pretty massive company. Not in comparison to something like Walmart, but he has dozens of employees and things like that. I have no idea what business structure he uses, but something like that could very easily justify the complications and the cost of creating a C Corp corporation or an S Corp corporation. So the last thing that I've been dancing around here, and the thing that is most common for small business owners to use, is what's called a limited liability company. Now, remember I mentioned before, limited liability companies don't actually exist. The IRS does not acknowledge limited liability companies. They're entirely a state-created thing. So when you are paying your taxes and things like that, the IRS is going to consider you either a sole proprietorship, a partnership, or a corporation when you are filing your taxes, and that requires filing different tax forms, different things that you have to pay, etc., etc. So what's the benefit of a limited liability company? Well, it's that idea of liability. Something goes wrong in the company, you get a loan for the company. To be able to, again, let's use our example of a live play. You guys have been using these little camcorders to record your live play. They're not great. You want to upgrade to like film quality cameras or broadcast quality cameras. They're not cheap. Generally, if you want something like that, minimum you're paying $1,500 to $2,000. You can pay an excess of $10,000 for a really high-end Kika camera, and nobody in your group has that kind of money. Well, as soon as you form your Kika company, you can actually go to the bank and request a loan uh, 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 to be able to pay for that stuff, and that's a whole involved process, but it's a thing you can do. However, you have to pay that loan back, and there might be other things, like maybe you do giveaways or something like that, and you have an account set up with a dice company that they give you so much credit to be able to give away dice, or maybe you sell dice, and so you have a credit with this Kika company. They give you, 10,000 to the dice that you can go ahead and sell as part of the Kika company, but you still have to pay that back. If your liabilities, all those loans and things like that, get too big, eventually the companies can say, no, we want our money now, can take you to court and start taking assets. With a limited liability Kika company, those assets stop at the company. So yeah, you probably won't be able to keep your cameras or anything else that you list as an expense of the business, but they're not going to take your personal car, they're not going to take your personal computer or anything like that. It's a huge, huge, huge advantage, because there are so many things that you can't anticipate that might cause the company to be found at fault for something. So a limited liability company simply protects everybody involved. It also means if there are multiple partners, it means that if one partner screws up, they might be able to tank the business. They won't tank everybody in the Kika company. Limited liability companies are relatively simple to set up. Every state has a slightly different process to do it, but if you type, setting up an LLC in Wisconsin, there's generally a pretty simple to follow list. Limited liability companies do generally require some sort of filing fee. Most places you're looking at maybe $100. It fluctuates, obviously, but it's not an exorbitantly large amount, especially if, again, you're making enough money to actually live off of your hobby. Paying $100 to get your limited liability status should not be something that's going to bankrupt your company. If it is, you probably shouldn't be considering turning the company into an LLC at that point anyway. You probably want to just continue dealing with your regular job till you have enough money to form a limited liability company. Now, because a limited liability company doesn't exist to the IRS, it does mean that when you form your limited liability Kika company, you also have to choose basically a secondary business structure. If you are the only person involved in this company that is running it, you have your mug shop, you're probably going to be an LLC that's also a sole proprietorship. Which means you still have to deal with self-employment tax and paying your personal taxes. If you have a bunch of people, you form a limited partnership. You still have to define, hey, this is how much each one of us owns of the company, etc., etc. If you want to be an employee of your company, even if you're going to be the only person that's a member of the board, you would form the LLC as a corporation, either a C Corp or an S Corp. Like I said before, if you want to go the corporation route, there are lots of benefits. It's very complicated. Get a lawyer. So once you decide on that, the final thing that you have to understand is a limited liability company, unlike a sole proprietorship alone, is a separate legal entity. That's why it creates that liability protection for you. And what that means is you have to treat it as such. If you have just a sole proprietorship, and by the way, a limited liability company that's technically taxed as a sole proprietorship actually has it's called I believe it's a single partner LLC or single member LLC. That's what it's called. It's a single member LLC. So your single member LLC, the IRS considers you a sole proprietorship, but you're not, because the company is separate from you. What that means is you have to create an actual separation. Part of forming an LLC should involve getting a bank account for your LLC. And the reason that's so important is if you create an LLC, but you still treat it as if it's just a sole proprietorship, that there's no difference between you and the LLC, that liability protection can go away. The process is called piercing the corporate veil. And basically all that has to happen is the person that is attempting to get access to your assets, all they have to do is show, hey, they treat this LLC as their own personal piggy bank. There's no difference. Like they use company funds to pay for personal things. They use personal funds to pay for company things. There's no difference between the company and them. So as much as, yes, you filed the paperwork for an LLC, we're not going to recognize the limited liability aspect. You're still liable for everything. So when you form an LLC, it has to have its own bank account. And anytime you take money from it, there has to be a paper trail. The most common way to do this is anytime you are going to use money, anytime you're effectively going to pay yourself from your new business, you do what's called an owner's draw. And that's basically, like, the simplest way to do it is you take the checks that you got when you opened the bank account that have your company name on them, and you write yourself a check for a certain amount of money, and then you pay yourself. That's called an owner's draw, and it leaves a paper trail. It means that now they can look at your bank account, they can look at the business's bank account, and they can see these are two completely separate things. They're not the exact same person, and therefore we're not allowed to take their assets. So if you do form a limited liability company, no matter what version of it is, if you're a single member, if you're a multi-member LLC, which is basically sole proprietorship and partnerships in LLC forms, or if you're a corporation, there always has to be a separation between the company and you, specifically from a money perspective, and there has to be a paper trail every single time, 100%. Anytime you are getting paid from the company, you have to have a paper trail. And anytime you are making purchases that have nothing to do with the company, it has to come out of your personal funds. So if, it's grocery day and you have nothing in your bank account, but the company has money in its bank account, you cannot just take the company card and buy your groceries. What you have to do is write yourself a check from the company, wait for the check to clear, and then buy your groceries. Anytime you use company funds to purchase personal things, that is more and more proof that you are not actually two separate legal entities. You are one and the same, and they're going to be able to pierce the corporate veil. So I hope that makes this a little bit easier to understand. Like I said, LLCs tend to be, again, relatively simple to set up. And as long as you are not having quote-unquote employees, there's not a whole lot you have to do aside from filling out some forms, paying a filing fee, and waiting. If you intend to have employees, you eventually have to apply for what's called an employer identification number, or EIN. That process in itself, again, is not particularly difficult, but it is more complicated than just filling out the forms. It might be something that you want to talk to a lawyer about. You can still hire independent contractors without having an EIN, I believe. Don't quote me on that. Again, talk to a lawyer before believing anything that I say. But having employees and stuff like that makes things significantly more complicated. Final thing that we need to talk about. What about everywhere else? Well, most countries, another drink, most countries have a version of LLCs. They're all called different things, and they all have different requirements. But in whatever country you are incorporated in or living in, there is more likely than not a version of a limited liability company. One of the more interesting things about Europe, specifically the European Union, is there are two groups, the European Cooperative Society, or the SCE, and the European Economic Interest Grouping, or EEIG. These are two groups that their entire purpose is to make it easier for businesses in European Union member states to be able to operate throughout the entirety of the European Union. So if you are in the EU, which is basically most of Europe except for the UK now, it's a good idea to look into either, again, the European Cooperative Society, or more commonly, the European Economic Interest Grouping. They have a lot of information about how to do it. As far as specific different versions of LLCs, in the UK specifically, their version of an LLC is called a limited company. LTD is, instead of an LLC, it's an LTD, limited company. In other parts of Europe, there is a French version that is accepted, I believe, throughout most of the European Union, if not all of it. It's called Société à responsabilité limitée, which is effectively French for limited liability company. Society is what I'm assuming the literal English translation would be, or something very similar. Effectively company, of responsabilité limitée, limited responsibility. It's literally a limited liability company. The abbreviation is SARL for that. And again, a lot of European countries recognize that as an accepted business type. And again, the purpose of it is the exact same thing as a limited liability company here, and it has similar issues. You still have to have separate business entity. You have to have a separate bank account. Things like owner's draws. I'm not sure if they have a particular method for doing owner's draws or anything like that. I'm not an expert on that, but those are all things that you want to look into. There's another one called the Societas Europaea, I'm assuming. I don't know what language it is. It doesn't look like French because there's not enough accents on it, but it's just called an SE. It's specifically designed for EU member states. Again, I'm not particularly up to date on exactly what it is, but again, it's another kind of version of a limited liability company, or an LTD. And then there's another one, SCE, which is Societas Cooperativa Europaea, which again, very, very similar. The big thing with these things is dealing with things like what's called the VAT tax, or value added tax, which is a thing that happens all over the European Union. It's mostly tax stuff. The other thing that makes most of these European flavors of LLCs different is a lot of them actually have minimum asset requirements, meaning your company has to have so much money invested in the company somehow before it's allowed to form. That the number varies from several $100s to a little over $1,000, depending on where you are. So forming an LLC in Europe in general is a little bit more complicated than the American version of it, and has more stringent requirements, including the company actually has to be making money. Here, literally anyone can form an LLC for any reason. As long as you got the money, you can form an LLC. It's not difficult. The European version requires you to actually have a functioning business before you can even start going through the process, which there are benefits to that. As I mentioned before, a lot of people will start a business or turn their hobby into a business without understanding how businesses work, and it ends up with them failing massively or getting in massive amounts of tax debt, or getting sued and getting damages awarded against them, and all these other things because they didn't understand how any of this stuff works. The European version of this requires you to at least understand it well enough to make enough money before you can apply for it. As far as everywhere else in the world, I would love to go through every single country and talk about their version of a limited liability corporation, but there's just tons of them. Each one is a little bit different. Most of them, the laws that regulate them are written in languages that I don't understand. And reading legalese is hard enough in a language that you speak. Reading it through Google Translate is not something I'm going to do. So if you're a non-US based person that's trying to turn your hobby into a business, look into whatever the local equivalent of a limited liability company is. Like I said, there are tons of them. A lot of them use the same words or very similar words. Or if you just go into Google in your country and type in limited liability company in general, in blah blah, in whatever country, it will generally give you something to go off of. As a wrap up, like I said, the big reason that we talked about these business structures is the type of business structure that you are using is going to dictate how the government views your business and how to deal with taxes and things like that, which is really, really important. Even if you had decided you don't want to go the LLC route, which I highly recommend if you are going into business for yourself, bare minimum, you need to file for an LLC. But even if you decide not to, the government really doesn't care. They're going to treat you as a company, even if you don't consider yourself a company, and you're going to be subject to all of the responsibilities that company owners have, including things like your self-employment tax, paying quarterly taxes. If you make, I believe in the States, if you make over, if your tax debt is going to be more than $600 by the end of the year for that company, you're actually required to pay quarterly estimated taxes, meaning you have to estimate what you think your company is going to make that year, divide it in 4, and then 4 times a year pay that amount to the IRS, so that when tax time comes around, you file your tax returns, and then they get to figure out, well, how good was your estimate. If you don't file the quarterly tax filings, you actually get fined. Even if you're planning on paying it during tax season, if it's more than $600 that you owe the IRS, which by the time you're able to make a living off of your company, you're going to be paying more than $600 a year in income taxes. Like, that's just how it's going to work. So yeah, it's a fantastic idea once you get your LLC set up to talk to an accountant. Most accounting firms have the ability for you to just pay hourly to talk to an accountant, and have them kind of walk you through the stuff that you need to do without having to have like an accountant on retainer or hire your own personal accountant or anything like that. Talk to one. Understand how paying quarterly estimated income tax is unbelievably simple. You can just log on to the IRS website and make a payment. As long as you attach it to something like your EIN or your Social Security number, if it's a sole proprietorship, that's all you got to do. It's very, very simple to do, but understanding how to calculate how much you should be paying for your estimated income tax is a little more complicated, and accountants are worth the money 100% of the time. So Interested to hearing back from you guys. Do you have any questions specifically about business structure and the process of forming a limited liability company? Like I said, I didn't go into specific details because the details themselves can vary, but for the most part, it's contact the state registrar, whatever it is, fill out a form, and pay a fee. There are other things you have to do, but generally they will be on the form that you have to sign up for the limited liability company. So I can't really get more specific than that than going state by state. But there are other aspects of business structure that I didn't explain very well that you have more questions about. If you are foreign to the U.S., if I got anything wrong about the various flavors of limited liability companies, feel free to correct me. I am not an expert on international tax law or international business law or European business law or anything like that. My degree is for American business, and it's been almost a decade since I got it. So, and are there other questions about turning your hobby into a business as far as the business structure is concerned? Let me know in the comments down below. Otherwise, again, that is all for me, and I will see you guys next time. All right? Bye-bye.